Motilal Oswal BSE Low Volatility Index Fund. Will this NFO help you create long-term wealth? Who can invest in this fund and who should avoid this fund? Let us analyze and explore. This fund's NFO is open till 16th March 2022, and this fund is an open-ended index fund. The benchmark of this fund is BSE Low Volatility Index. Exit load is 1% and minimum investment is just 500 rupees. Understanding the investment objective is very much important in order to evaluate a fund. The investment objective of this fund is they will replicate, mirror, and mimic BSE Low Volatility Index. Subject to tracking error and expense ratio, this fund will give similar returns to BSE Low Volatility Index. What is BSE Low Volatility Index? Top 100 companies are large cap companies and next 150 companies are mid cap companies. Out of these 250 large and mid cap companies, based on certain parameters, BSE has chosen low volatility stocks, top 30 low volatility stocks out of these 250 stocks, and constructed BSE Low Volatility Index. This fund invests in this low volatility index in the same proportion given in the index in all the stocks in the index. So they will invest in all the stocks in the same weightage given in the index. Because it's investing in low volatile stocks, this fund may be an opportunity for investors to invest in low cost smart beta index. Top 10 holdings of this particular index is well-known companies: Gillette, Maruti Suzuki, Pidilite, Infosys, Nestle, Dabur, Britannia Industries, Klaxo, ITC, SBI Life. Not only well-known companies, the top holdings are spread across multiple sectors like consumer goods, automobile, chemicals, IT, pharma, and financial services. Because of that, the portfolio seems to be well diversified. As we have looked at the basic structure of this fund and investment strategy of this fund, now is the time to evaluate this fund. Now we are going to present our key findings which are in favor of this particular fund. What are all the potential merits of this fund? We are going to discuss. As we have already seen, this is a well diversified portfolio that can deliver long-term growth. Companies are well known and seems to be having better sustainability. This fund is obviously suitable for ultra conservative investors who are looking for exposure in their core equity portfolio. Right? Compared to an actively managed fund, the returns from this fund are relatively stable with less volatility. Normally in the actively managed funds, they will have higher beta compared to an index. As they are going to simply replicate the index, volatility will be less and stability will be more. In this fund, the fund manager is going to buy the entire index. Normally in the actively managed fund, the fund manager will do his own analysis and choose best stocks based on his analysis. In his analysis, because of his judgment or some other error, he may end up choosing a poor stock, right? So there is a fund manager bias. Because of that, stock selection risk is there in the actively managed fund. Here, there is no fund manager bias because he is not going to do any analysis. He is going to simply buy the entire index. That way, there is no fund manager bias or stock selection risk in BSE Low Volatility Index Fund of Motilal Oswal. Obviously, they are investing in 30 low volatile stocks. This fund is managed passively, so expected to have lower expense ratio compared to actively managed funds, because in the actively managed fund, the fund manager has to do in-depth research on the balance sheet, profitability, sustainability. Here, there is no such risk. There's no such expenses. So because of that, obviously, expense ratio will be lower. As we have analyzed what are all the potential merits of investing in this fund, now is the time to analyze what are all the potential demerits, our key findings which are against this fund, that we can discuss in detail. As this fund invests in equities, obviously it is not suitable for short-term investments. Anyone who has got 1 year, 2 year money, they should avoid this fund. Equity investments are suitable for long-term investors, investors who have long-term money. When I say long-term, it means 7 years plus. Within these 7 years, there will be periods of low return, no return, negative return, and good return. So in which combination it is going to come, which order it is going to come is not known. That is why like staying the course for entire 7 years is important. So long-term investors can choose this fund, consider this fund. However, short-term investors, strictly they have to avoid this fund. Because of the tracking error and expense ratio, this fund may not be able to deliver same return as of index. This fund, there's a high probability to underperform the respective index. This is an index fund. They will mirror the index fund. Because of that, they will not be able to beat the index. Market beating returns is not something this fund will not be able to deliver. Normally in the actively managed fund, the fund manager will be able to generate alpha because he chooses the best stocks in the index in his portfolio. Because of that, actively managed funds has got a higher potential to beat the index. Here, there is no possibility of beating the index. Again, based on the market outlook, the fund manager will not be able to change the allocation from one capitalization to other capitalization or one sector to other sector. If the large cap outlook is brighter in the actively managed fund, the fund manager can have higher exposure to large cap. If the mid cap outlook becomes brighter, he can reduce the exposure to large cap and have higher exposure to mid cap. This active management, this dynamic management is not possible in this index fund because they have to mirror the index. Similarly, if the outlook for one particular sector is positive, outlook for other sector is negative, changing the allocation, it is not possible for this fund. They have to mirror the index. Here, the fund manager will buy the entire index. He will not pick and choose any stock. He will not look at the balance sheet of any of these stocks. He will not do analysis on any of these stocks. Simply blindly buy all the stocks in the index at the same proportion. They will be doing it. They will not check the sustainability. They will not check the soundness of the company. P/E ratio, no analysis of the company is done. They have to simply mimic and replicate the index. Whereas in the actively managed fund, the fund manager will do all the analysis, sustainability, profitability, how good the management is, long-term potential, outlook of the sector, everything will be analyzed in depth by the fund manager. So the fund manager will be taking better calculated risk in the actively managed fund. Whereas in the passively managed fund like Motilal Oswal BSE low volatility index fund, the fund manager will not take any calculated risk. Because of the tracking error, they will not be able to properly mimic the index. It is one of the major drawback of this particular index. And course correction is also not possible. Proactive management is also not possible. In an actively managed fund, if the market outlook is bearish, then the fund manager can change the portfolio into defensive stocks so that fall will be less. Similarly, when the outlook is bullish, then the fund manager can change the portfolio into growth stocks, momentum stocks, so that he'll be able to have better return. These kind of proactive management or course correction, both are not possible in the index fund. they can't do any changes. They have to simply replicate the index. So that way, dynamic management is not possible for this particular fund. Now, what is the final decision? As an investor, do I have to invest in this fund or do I have to avoid this fund? This fund is obviously suitable for ultra conservative investors who is not willing to invest in actively managed funds. Choosing an actively managed fund is not in the circle of competence of yours. Then in that case, obviously, these kind of funds are suitable for you. Again, in this particular category, there are existing BSE low volatility index funds which has got proven low tracking error and low expense ratio. The ability of this Motilal Oswal S&P BSE low volatility fund to maintain low expense ratio and low tracking error is untested. We have to wait and see the track record, how far they will be able to maintain low expense ratio and low tracking error. We have to wait and see. However, there are existing proven funds. So for an investor, proven track record is better. Actively managed funds has got a higher potential to deliver higher returns than this fund because they pick and choose the best stocks, so they have got better potential to deliver more returns than this fund. If you are expecting dynamic fund management, moving from one sector to other sector or moving from one capitalization to other capitalization, this fund is not suitable for you. Also, if you are looking for market beating returns, then it is definitely not suitable for you. If you have any questions related to this particular fund or any other investment option, feel free to book a free appointment with our financial planner. The registration link for the free appointment is given below this video in the description box. Will you be interested to attend insightful investment webinars? Then take advantage of our upcoming webinar. The registration link for the upcoming webinar is given below this video in the registration link. We organize regular insightful webinars. Register and get to know the strategies to create long-term wealth. If you like this video, please give a thumbs up. If you know anyone in your social circle to whom this video will be of use, please share this video with them. Last but not the least, if you're not subscribed to our YouTube channel so far, please subscribe to our YouTube channel today, now, so that you will not miss any of our future videos. Bye. Thank you.